Hello, and welcome to Financial Accounting. Today, we will continue studying the fundamentals of revenue recognition. We will look into a demonstration problem to gain a better understanding of how to determine the transaction price and how to record transactions with multiple performance obligations. I have several videos about revenue recognition. I am sharing the link to the playlist here and in the description below. Now, let's get to the demonstration problem. Range and Farm Supplies Company distributes range and farm equipment, offering a wide range of products from small tools to power equipment. Most of its products are available for direct purchase through its company's catalog and website. Additionally, select farm supply stores carry range and farm products, particularly specialty items. Please take a note of the following details. Range and Farm Supplies sells 3 grain dryers to a local farmer for a total contract price of $45,200. The standalone selling price of each grain dryer is $14,000, with a cost of $11,000 each. The standalone selling price is the price at which the entity sells its goods and services separately to a customer. In addition to the dryers, Range and Farm Supplies provides installation services with a standalone selling price of $1,000 per unit installed. It also provides a dryer maintenance plan for all 3 dryers for 3 years after installation for $1,200. Range and Farm Supplies signs the contract on June 20, 2024 and receives a 20% down payment from the farmer. The dryers are delivered and installed on October 1, 2024, and full payment is made to Range and Farm Supplies. We need to calculate revenue for each performance obligation and prepare journal entries for 2024 related to this arrangement. This revenue arrangement involves 3 distinct performance obligations. 1, the sale of the dryers. 2, installation. And 3, the maintenance plan. A performance obligation is a promise to provide a distinct good or service or a series of distinct goods or services as defined by the revenue standard. We will look at the revenue standard in the next slide. When a company agrees to perform a service or sell a product to a customer, it has a performance obligation. When this performance obligation is satisfied, it's time to recognize revenue. Therefore, the revenue recognition principle requires companies to recognize revenue in the accounting period when the performance obligation is satisfied. Just a reminder, revenue recognition is one of the basic principles of accounting. The revenue recognition principle requires companies to recognize revenue in the accounting period when performance obligation is satisfied. I have a video in which I go over the revenue recognition principle, including the 5-step approach to revenue recognition. I am posting the link here and in the description below. Let's take a quick look at Accounting Standards Code Topic 606, which provides guidelines for revenue recognition. At contract inception, an entity shall assess the goods or services promised in a contract with a customer and shall identify as a performance obligation each promise to transfer to the customer one of the following: A good or service or a bundle of goods or services that is distinct, and B, a series of distinct goods or services that are substantially the same and that have the same pattern of transfer to the customer. I am posting the link to my video about accessing the ASC online here and in the description below. I will also post the link in the comments section. Let's review. Identifying performance obligations is critical in revenue recognition because revenue is recognized when a performance obligation is satisfied. Failing to identify performance obligations correctly may result in the timing of revenue recognition not complying with the requirements of revenue recognition standard and revenue being recognized in the incorrect reporting period. Now let's get back to our example. The total revenue of $45,200 should be allocated to the performance obligations based on their relative standalone selling price. We have 3 dryers at $14,000. Total is $42,000. Installation services for 3 dryers, $1,000 each. The total is $3,000. The maintenance plan for 3 dryers is $1,200 for 3 years following installation. Total estimated standalone selling price is $46,200. The allocation for a single contract is as follows. The contract price of dryers is $41,091, or 90.9% of the total price. It is calculated as follows. The standalone price of dryers of $42,000 divided by the total standalone price of $46,200 and multiplied by the total contract price of $45,200. The contract price of the installation services is $2,935. $3,000 divided by $46,200 and multiplied by $45,200. The maintenance plan contract price is $1,174. $1,200 divided by $46,200 and multiplied by $45,200. Now let's prepare journal entries. Remember, Ranch and Farm Supplies signed the contract on June 20th, 2024 and received a 20% down payment from the farmer. The dryers are delivered and installed on October 1st, 2024, and full payment is made to Ranch and Farm Supplies on the same date. Maintenance revenue needs to be recognized based on how many months dryers are under maintenance in 2024. We record the first entry on June 20, 2024, when the contract was signed and the down payment was received. We assume that the contract is non-cancelable. We record a debit to cash of $9,040, which is 20% of the contract price of $45,200. Cash is an asset account and is increased by debit. I have a video going over the rules of debit and credit. I am posting the link here and in the description below in case you need to review the rules. Accounts receivable is also an asset account and is increased by debit. We debit accounts receivable by $36,160, which is the difference between the total contract price and a down payment. This is a compound journal entry that includes multiple debits and credits. Total debits are $45,200. Now let's move to the second part of the entry. We don't recognize revenue at this point since none of the performance obligations were completed. We record a liability for each performance obligation by crediting appropriate liability accounts. Remember that liability is increased by credit. Unearned sales revenue, dryers, is credited by $41,091. Unearned service revenue, installation, is credited by $2,935. And unearned service revenue, maintenance, is credited by $1,174. Note that the total of credits is $45,200. Always make sure that total debits equal total credits. Next, the entries are recorded on October 1st, 2024, when the final payment is received and dryers are delivered and installed. At this point, we can recognize revenue from the sale of dryers and installation services. Cash is received for the balance of the contract. We debit cash by $36,160, which is 80% of the total contract price of $45,200. Accounts receivable is credited by $36,160. At this point, the balance in accounts receivable for the contract is zero. Unearned sales revenue, dryers, is debited or decreased by $41,091, and unearned service revenue, installation, is debited or decreased by $2,935. At this point, the balances in both liability accounts are zero. Service revenue, installation, is credited or increased by $2,935, and sales revenue, dryers, is credited or increased by $41,091. Revenue is increased by credit. We also need to record the cost of goods sold. We assume that company maintains a perpetual inventory system. Cost of goods sold is increased by debit, so we debit the cost of goods sold account by $33,000. The cost was given to us, $11,000 for each dryer. Inventory is an asset account and is decreased by credit. We decrease or credit inventory by $33,000. Alternatively, we can record all three entries as one compound journal entry. Make sure debits equal credits. The last step is to record maintenance revenue. It can be recorded monthly or at the end of the year. Since the amount is small, we will record it at the end of the year. On December 31st, 2024, unearned service revenue, maintenance, is debited or decreased by $98, and service revenue, maintenance, is credited or increased by $98. Service revenue for maintenance is recognized for 3 months, October, November, and December, since the installation was completed on October 1st. To calculate the 3 months of maintenance revenue, 1,174 is multiplied by 3 months and divided by 36 months. The maintenance plan is for 3 years or 36 months. I hope you found this video helpful. If you did, please make sure to subscribe, hit the like button and ring the notification bell so you are notified when we release more videos like this. Thank you all for watching, and I hope to see you all again in the next video.